Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, the past week saw markets stabilize a bit after a chaotic stretch. What's driving the shift in tone?
Yes, it's been a slightly calmer week, but only on the surface. The real reason markets are taking a breather is this 2-week diplomatic window that's opened around Iran. Geneva has suddenly become the geopolitical epicenter, with European powers, Germany, France, and the UK, trying to revive nuclear talks with Iran. For now, that's enough to calm nerves. But let's be clear, the backdrop remains fragile. Iran is demanding an immediate Israeli ceasefire before it makes any real nuclear concessions. Meanwhile, Oman is quietly working behind the scenes on a ceasefire proposal, which might, just might, bring oil prices and tempers down. And yet, there's a deadline hanging over this entire process. President Trump has said mid-July is decision time on whether the U.S. joins Israel militarily, so this is far from over. The market's pause could be short-lived if these talks collapse.
And while the headlines are focused on geopolitics, market volatility remains surprisingly muted. What's going on there?
Exactly. It's almost eerie. If you look at the VIX for equities or the MOVE index for bonds, they're both well below recent highs. It tells you markets are in wait-and-see mode. The oil price tells the real story. Brent spiked above $77 earlier this week and has since pulled back about $2, but remains volatile. Investors are clearly watching Geneva, but not rushing to reposition yet. There's hope that diplomacy will prevail, but I'd call this a false calm. The risk is still skewed to the downside, especially if those Geneva talks break down and military action becomes more than just posturing.
Let's shift to central banks. The Bank of England held rates steady. Any surprises there?
No real surprise on the BOE holding at 4.25%, but the messaging was hawkish. They basically said the oil spike and global unrest could delay the start of easing, and the market heard them loud and clear. The pound actually weakened, pricing in a later first cut, maybe not until August or September. This is part of a broader pattern. Central banks are being forced to reassess timelines, not because of domestic inflation, but because of imported inflation from oil and food. We even had UK inflation data show chocolate prices jumping 17%, driven by cocoa shortages linked to weather disruptions in Africa. These are the kinds of details that quietly reshape policy outlooks.
Japan also made headlines this week, with inflation finally doing something it hasn't done in decades.
Yes, Japan is in uncharted territory. Core inflation hit a 2.5-year high at 3.3%. For a country that spent the last 30 years trying to find inflation, this is a big deal. The Bank of Japan is likely going to have to hike again at their July meeting. It's a fascinating shift. For years, Japan was the world's monetary anomaly. Zero rates, massive stimulus. Now they're being pulled into the global tightening cycle, just as others are trying to find off-ramps. And it's happening as the yen weakens, which is compounding inflationary pressure. Japan is no longer the global deflation anchor it once was.
Let's talk gold. Still climbing, but looks like it hit a ceiling this week?
Gold's been a steady story of quiet strength. We're sitting at around $3,350 an ounce, comfortably above the 200-day moving average. But momentum has paused, likely because of the Geneva talks. If we get a diplomatic breakthrough, expect some profit-taking, maybe back toward the $3,200 level. But here's the thing. Gold isn't just about geopolitics. It's also about the shift in global capital away from the US, from traditional assets, and into real stores of value. That trend is intact. If Geneva fails and oil surges again, gold could become the market's hedge of choice, again.
That's it for this week. Stay tuned for more insights next time.